Welcome everyone to the 4 pillars of commercial success. This presentation is nearly 20 years in the making because around about 20 years ago, myself and my business partner, Paul, set up the Wow Company. And what we do today is we provide accountancy services for agencies, consultancies, and tech companies with between 8 and 80 staff. But for every single one of those 20 years, we have been on a mission. And that mission is to help you build a beautiful business, a business that is guided by purpose and is on a mission to achieve your own personal ambitions. Now, whatever it is that you want to achieve personally, you will not get very far unless you get great commercial foundations in place. And my job here today is to share with you what I have seen the top performing businesses do throughout every single one of those 20 years. And most importantly, especially recently, when times are challenging, what are the foundations that they put in place, the pillars upon which they build their success? I'll be taking you through those 4 pillars of commercial success here today. So let's get started. The very first pillar I'll be taking you through is an important one, and you'll all recognize it's important because it's this. The first pillar of commercial success is winning new business, because we all know that lightens the mood, doesn't it? It makes everything easier when new business is flying in. And what I'd really like to talk about here today isn't the moments when new business flies in, it's building that pipeline and doing so in a way that is consistent and predictable and systematized, because that is what I see the top performing businesses do when it comes to winning new business. They have a system and a process. And today I'm going to show you a little insight in the time that we have as to what that process looks like. Now, for all of these pillars, and this one, it definitely applies, but especially for all of them, it's really important that we think about what's next for us. So everyone here will be out there winning new business to varying degrees. And if you're doing particularly well at this, my challenge for you is, well, what's the next level? I'm going to take you through what the next level might look like. So there's 5 ways I see we can all raise our new business game right now. And the first one is for us all to understand our pipelines in more detail than ever before. And in particular, what I want to get us thinking about is our conversion rates. And our conversion rates as we go down the pipeline stages, from a lead to a sales conversation, to a proposal, and then finally to a sale. And by the way, those pipeline stages, I have simplified it hugely. You could break each of those down into far more sections, looking at marketing qualified leads and sales qualified leads and consultations and discovery sessions and so on. But I've kept it simple, from moving from someone's name through to having a conversation with them, issuing a quote, and then a deal. Now, at each stage, are you clear about your conversion rates? And when I say clear, I mean, have you got data that shows you what your conversion rates are, from lead to sales conversation, proposal to sale? And I've popped some typical ones there. Now, once you are clear on those, based on data, not guesswork, actual data, what that allows you to do is work backwards from the sales that you want to make. And let's say you need to do 4 sales per month or per quarter. And by the way, that number will be based on some detailed planning. Hopefully it'll be based on detailed planning, working out what it is that you need from your new business. And that will be based on your average client value. Again, data that you have, not guesswork. So based on your average client value, let's say you need 4 sales. Now, at a conversion rate of 50% from proposal to sale, you're going to need to issue 8 proposals in that period of time. And if in order to issue a proposal, you've got a 1 in 3 conversion rate from a sales conversation, then you're going to need to have 24 sales conversations in that period. And if 1 in 5, 20% of leads results in sales conversations, then you're going to need 120 leads in that period, whether that's per month or per quarter or per year. Now, this is the scientific approach I would encourage you all to take to help you work out empirically exactly what you need in any given period in order to achieve your objectives. Because once you've worked out that 120, how many leads you need, you can then work out where those leads are going to come from very, very clearly. And looking at all of the ways that you generate opportunities, whether it's through referrals or networking or downloadable content or social or email outreach or whatever it is that you're doing, you can then start to think, well, okay, in this period, how many are going to come from each source? And is there a deficit? Now, if you're sat there thinking, my goodness, there's a big deficit, how on earth am I going to get to 120? A key lever that we can all pull is to increase our average transaction value. If you double your average transaction value, then you're going to need half as many leads, half as many opportunities. So have a think about how you can increase your average transaction value in order to reduce the volume of leads that you will need. So that's the scientific approach. And by the way, this is a screenshot from a spreadsheet that we've created and we can give away for you for free. Hugh's very kindly going to share a link to it in the chat. You can create your own copy. You can have a play with this. It's called our lead calculator spreadsheet. There's some other interesting tabs in there that you can look at sales velocity and things. So take a look at that spreadsheet and do the calculations yourself. Work out exactly what activity you need to do. Because what you can then do is plan much further ahead. And this is my second challenge to you today, is to plan in far more detail than ever before. Whenever I go into businesses that are doing well, that have full sales pipelines, they can all show me planned activity for the next 6 months. They know exactly, based on the number of leads that they need to produce, what activity they're going to do every single month. They've thought about it meticulously, because it might be they need to produce a piece of downloadable content a month, or run a webinar a month, or go to 3 networking events a week, or do all of those things. But they will have thought very carefully about what activity they need to do, and they'll have planned it in. Have you got a plan for the next 6 months? If I walked into your business tomorrow, how much detail would you be able to go into? And if you can't produce it, then my suggestion is straight after this, you go away and start thinking about what that might look like. When you do that, when you produce that plan, the third way for us all to raise our game is to start thinking about resourcing. And almost certainly, when you look at that plan, you will want to spend more time on new business. This is the #1 challenge facing business owners right now when it comes to winning new business. We all want to spend more time on winning new business. Now, solving this challenge is easier said than done. There are 3 ways you can solve it. As I said, this is not easy. So we'll have probably tried one or more of perhaps all of these things. And I've got some ideas about how you can make them successful. So the first way that you can spend more time on new business is to hire someone to do new business activity. Now, that might be a salesperson. And we all know that is risky. Well, first of all, it's going to take time for them to build that pipeline. You're looking at least 6 months before you're actually going to know whether or not they're successful in their role. And we all know people who've tried this and it hasn't worked and it's been expensive. So if that feels too risky for you, then maybe that you could hire someone to do perhaps elements of your role to free up your time, or to do elements of the new business process. So maybe they're good at the lead generation element, freeing you up to do the face-to-face element of it. And, I was speaking to, it was a client of ours actually at a networking event. We bumped into each other and he was saying, I need to do more new business. But, so he's creative director at an agency. And he said, it's not really my thing, going out and doing the networking. And, I'm much better once I get in front of people when I get to do the creative bit. And I said, well, why don't you just hire someone to go out and do the networking and lead gen, someone who's brilliant at that. And they just wheel you in for the bit that you're really good at. And he said, oh my God, yeah, so obvious, really. I can split that role up. And my challenge to you is, well, could you split your role up? Hire someone to do elements of your role, or hire someone to do elements of new business. Maybe, by the way, you're bogged down with nothing to do with sales. You're bogged down with maybe account management or project management or delivery within your business. And actually freeing or hiring someone to do some of that client work will free you up to do more of the things that you want to do, more new business activity. So the third way to do this is get external help. And what I love about this option is it creates a rhythm. It creates an accountability to someone who's every single week, every single month, you're paying to do activity. The challenge when we do it ourselves is when we get busy, we often forget about it, right? And we go through this classic boom bust cycle. The beauty about getting external help, whether that's a new business agency or marketing support, or someone to help with elements of your marketing, is every single week, every single month, they are working on your behalf in order to generate you the leads that you need. So have a think about which of those might be the path forward for you. But what I'd suggest is just carrying on. Once carrying on with the current resource is not going to change things. You need to think about what extra you can do and how you can really ramp up your new business activity. Because let's be frank, it is challenging out there. Everyone I speak to is talking about how challenging it is, and how even when you get decisions made, even when you win deals, they're taking longer to actually come to fruition, or budgets eventually being pared back. So we just need to work harder at this, and smarter as well. Think about where your new business opportunities come from. And the other thing that's going to really help, the fourth way that we can all raise our game here, is to measure daily or weekly early indicators. You've heard me talk a lot in the past about the difference between leading and lagging indicators. It's these leading indicators, these very early indicators that I'm interested in, the things that you need to track every single day or every single week that will tell you in the future whether or not you're going to win the work you need to fund that quarter's growth. So good examples of daily or weekly indicators are things like, well, how many booked calls did we have this week? How many downloads of our guys did we have this week? How many new people booked onto our events? How many networking events have we attended? It's the things that you can affect. How many coffees, conversations have we had today? It's the things you can affect every single day. I heard a lovely story from a consultancy that's built a huge business, a £300 million business. But when they started from nothing. And we all remember those early days, the hunger of, well, I've got nothing else to do. I've got no clients, no work. I'm just going to have coffees and lunches and chat to people. And those were the foundations on which they built their business. It's the foundations on which we built ours. I remember my target at WOW was just book 3 meetings a week. And we knew with a roughly 1 in 3 conversion, we might pick up 50 clients by the end of year 1. And that was the only thing that mattered. How could we all get back to that in our businesses? No matter what size we are, there's still something magical about having that hustle and focusing on those daily or weekly indicators that really make a difference. Now, the 5th way that we can all raise our game when it comes to new business is do exactly the same as I've just suggested for new clients, for existing clients, because we have untapped opportunities right underneath our noses. Every single one of us listening to this could do more for our existing clients. And by the way, this isn't just about selling to them. Every time you issue an invoice to a client, it is a demonstration of the value that you are adding for them. And if you are not going to them with ideas, if you're not going to them with ways to solve their challenges, then someone else probably is. And you don't want that to happen. So go and pitch ideas to your clients. Go and tell them how you can help them, how you can add value. And actually, when things are challenging, it's a really good opportunity for us all to think and work out what clients really do value. What are they willing to pay money for? Because right now, people are paying money to businesses just like yours to solve their challenges. What are those challenges? How can you position yourself? And going to existing clients who already know and love you, and you already have a relationship with, is a great place to start. So get into that discipline of, I know one client that meets every week, they bring their team together and they say, right, let's brainstorm ideas for this client and let's go and pitch to them these ideas. Now, the worst that happens from that scenario, by the way, is the client comes away with a load of great ideas and knows that you care. But I promise you, if you do that every single week, good stuff will happen. So the second pillar we're going to talk about today is profit and cash. No surprise that I'm talking about these two things. They're super important in building the commercial foundations for your business. And let's start with this. Let's start with cash reserves, because running out of cash is what will cause businesses to go bust. We can survive lots of catastrophes as a business, but running out of cash is the one thing that we cannot survive. It's the oxygen that keeps us going. So when it comes to cash reserves, I'd encourage you all to set a target for the number of months of overheads that you want to retain as cash. And the target that you set will often depend on your starting point. I accept that, but it will depend on a whole host of factors. So, I know some people who want 12 months of overheads as cash in the bank because they have particularly volatile businesses with, big clients that with no contracts in place and long payment terms. So if projects get delayed, if clients change their minds, that has big, lumpy implications on their cash flow. Other businesses are quite comfortable with 3 months because they've got lots of clients, a broad spread of clients, all of whom are on direct debit, for example. A lot of those are on retainers and it just drips in. And so they're better able to withstand shocks. I think having somewhere between 3 and 12 months is a really good thing. Where is that position for you? What is your level of comfort? What target do you want to set for it? Now, once you've set that target, you can then do things that will help you get there. And what will help you get there is getting the basics right when it comes to cash management. And I thought everyone knew how to do this, right? And maybe because of the world I live in, running an accountancy practice, I just assume that everyone gets this. They don't. And I found this out very recently when we took on a client that had been going for 30 years, a really well-respected agency, been going a long time, successful, solid. But my goodness, their cash management could have been done a lot better. Within a month of working with us, we had whipped them into shape. Let me show you what we did. We've got sort of before and after, and hopefully this triggers a few thoughts as to some of the things that you could do. So the first thing we looked at was their payment terms on invoices. And we said, oh, no, 30 days. Why are you putting 30 days as your standard terms? Your standard terms with which you need to negotiate with clients, with blue chips who will happily take forever to pay you. Let's reduce that down to 7 days. It doesn't stop, large corporations say, well, we're going to pay you 60 days net. But at least you can then negotiate from a position of 7 days rather than 30. Second thing we did was increase the amount that they ask for upfront. So they were a typical project value for them was about 100,000. So they were asking for about 25,000 upfront. We suggested, and they accepted the suggestion, to move to 50% upfront, because that's where the majority of the work is. Think about where all the effort is in the project. It's all up front. And it's important that that's reflected in the payment terms. Now, for smaller businesses who are issuing projects, I'd say probably under 20 grand, there's a case that you can invoice all of it up front. And I know plenty of businesses that do for projects under 20, 25 grand, invoicing all of it up front. Whatever you do, there needs to be a relationship between the billing and the work. You do not want to leave a chunk of billing till the end. So make sure you bill as much as you can up front. We also switched their payment method from backs to direct debit. Now, again, if you work with big blue chip companies, they're not going to sign a direct debit, but you would be surprised how many other companies are willing to do that. And by switching, I think we got to something like 70% of their clients now on direct debit. We use Go Cardless, or they use Go Cardless. And that made a big difference too. Debtor chasing was random and manual, and typically they forgot to do it. You can automate it using Xero. You can, if someone hasn't paid the bill within 7 days, you can send an email reminder automatically whilst you sleep. You don't need to think about it. Their debtor management, there was no formal process. So we suggested they just, stop work after 14 days. If they're not paying you, why carry on? Let's give them an incentive to pay. So stop work after 14 days if an invoice is overdue. And we also put someone in charge of this process. So there was one person responsible looking at this every single week. And what that did to their receivable days was this. When we started working with them, it took them on average 50 days to get paid, 50 days to get paid. It's now 20 days. So they're getting paid a whole month quicker than they were just by implementing some very, very simple, what I think are simple practices. So if you've ticked all of those boxes, awesome. If you haven't, there might be some things that you can sharpen up on. So question I have for you is, have you got the right financial infrastructure in place? Who is challenging you on those decisions, on your cash flow management? Who's looking at that data? Who is giving you guidance to help you be in the best shape possible? Because right now, when things are challenging, we need to be in the best shape possible. There is no room for error. Now, cash is one of the biggest lagging indicators. Profit is the precursor to cash, and it's really important that we focus on that in order to get cash in the bank. Just by setting a target and improving your cash flow, that's part of it. Making sure you're profitable is the essential element of this jigsaw. So it is all of our responsibilities to know empirically within our businesses where we make money and where we lose money. So do you know in your business where you make money and where you lose money? Because right now, in every single one of our businesses, including my own, there are things that we do that make money, and there are things that we do that actually lose us money. And once you understand this, that gives you the opportunity to make some changes. So how do you work this out? Well, you need to measure your gross profit in detail. And by in detail, I mean by project. Every single project that you work on, are you clear in real time whether or not you're making money on it, whether you're ahead or behind? Doing it in real time gives you the opportunity to correct yourself if there's an issue. Are you measuring it by client? I'm sure if I asked for a league table of clients by revenue, you'd be able to give me that, but can you produce a league table of clients by profitability? Which ones are making you money, which ones are not? And then also by product or service. So are you able to tell me which parts of your business make money, which teams within your business make money? Can you even break that down into an individual team member? So someone who's earning £40,000 a year, are they billing £80,000 a year or more in order to get the sufficient margin? What level of detail can you currently produce? And what is the next level for you? Because once you see this stuff, and there's been countless examples over the years of clients that thought they were making money and then suddenly realized that all of the money that they are making is from one particular service, and others are literally losing the money. And overnight, they can shut down services. They can divert attention to their most profitable ones. Knowing is real power in this scenario. Data is important. It's also important that you set a target for your gross profit percentage. Now, if you're a service business, so typically we work with agencies and consultancies, but it applies to any service business, then you need to be aiming for 50% plus. Now, this is hard to achieve. The majority of service businesses are beneath that, but it's really important that we all strive, we all think about ways to get to that 50% plus. And measuring your profitability in detail will help you understand where you're making money, where you're not, and you can do more of the first, less of the second to help you get to that 50%. Now, if you're a tech business, your margin, your gross profit margin is going to depend on a whole host of things, type of clients, level of maturity within your business, and come and speak to us and we can make an assessment of where you're at if you'd like and what your gross margin should be. Now, when you're putting together these plans, when you're thinking about your 50%, it's really important. An important part of this pillar is operating with excess capacity. You do not want to be at a point where one slight knock can send you over. So there's no point being at 50% gross margin and 20% net profit if everyone is absolutely flat out and there's no room for maneuver, because what happens is people get burned out, they get tired, they make mistakes, they leave, and that sets you back. So it's important that you hit those numbers, but with excess capacity. Now that makes this even harder. And if you sat there thinking, crikey, I'm nowhere near 50% and everyone's flat out, you need to think very carefully about your business model, right? This is the game we all need to play. There are clues that we're not doing the right things. If we're not hitting that 50% with excess capacity, quite frankly, we're not doing the right things. So what do we need to do differently? Though that's the thinking exercise we all need to go on if we're finding it challenging right now. What do we need to do differently? It might be something with our proposition. It might be something with the type of clients that we're working with. It might be something our internal workings, the people that we have on projects, but we need to find a way. The third pillar of commercial success I'll share with you today is recurring revenue. Everyone loves recurring revenue. Well, nearly everyone, because we did a bit of research that showed that 83% of businesses want more recurring revenue. And that astonished me because I was sat there thinking, well, who are the 17% that don't want more recurring revenue? You know, I have lots of recurring revenue in the businesses that I'm involved with, and there's not a single day that goes by where I don't want more of it. Thank you. Because recurring revenue helps us all sleep better at night. It helps us all plan for the future, make investments with much more confidence because we have that solidity. So where do we go with this pillar? What more can we do? Well, the first thing to say is recurring revenue won't happen by accident. We've got to think consciously about how we generate more recurring revenue. And it all starts with a target. You know, I love a target, but what target do you want to set for recurring revenue? Whatever level you're at, what is it that you want to set? So some people, some businesses that I hear will say, well, look, I'd love to get to the point where my overheads are covered each month by my recurring revenue. Some people are just starting out on this journey and saying, well, look, I'd love to get to 5 grand a month or 10 grand a month. Or other people say, well, I want 75% of my revenue to be recurring. What target do you want to set? And then you can go on a journey with it. And then there's some questions, some very important questions we need to ask ourselves. Do you have the right products and services that lead to recurring revenue? And we worked on an exercise with a client, and they had 2 parts of their business: a web design business and then ongoing marketing support. So that was a combination of social and SEO and online, various bits of online marketing. So web design and then online marketing. Let's brand them as that. And the question we asked them was, do all paths lead to recurring revenue? And when they thought about it, if they wanted more recurring revenue, which they did, it wasn't really clear from the outset of their relationships that that's where the path led to for clients. So they changed something, they flipped something. So first of all, what they did was they repositioned things on their website. So they led with the marketing support rather than the web design. So it was clear that is where they added the most value. The second thing they did is anyone who came to them looking for a web project, they said, well, look, there's 2 prices. We can absolutely do you a web build, and the price is going to be this. It's going to cost you 30 grand. However, if you commit to a 12-month program activity afterwards, and here are the benefits of doing that, then this is the price. That 30 grand becomes 25 or 22 if you commit to this ongoing program of work. And so they were deliberately channeling people through to the place where they wanted them to go, to that recurring revenue. The next question for you to think about is, are you targeting the right type of clients? I was in conversation with an agency owner recently who told me that they'd had a bit of an epiphany recently. They were just targeting the wrong type of clients that were good for, one-off projects, but they were never going to commit over a longer period of time at the level that this agency wanted to the amount of work required. So they had this epiphany. They said, well, we're just going to make sure we target all of our marketing at businesses that we know have a good chance of working with us over a 3-year period. So they have the budget, they have the inclination to do this type of work over the next 3 years. So rather than just being one-off, because it takes so much energy to win a client, doesn't it? And they just figured it just wasn't worth that energy unless there was an opportunity to work with them over the next 3 years. So are you targeting the right type of clients? And there's been several occasions I've asked this question of people, and they've suddenly gone, well, quite frankly, no. We need to up our game. We need to find bigger clients with bigger budgets and change our positioning as a result. I've told this story before, but it's worth telling again. The video production agency that figured this out, they went from doing, I think, 40 grand video projects to working out that really they needed to move upstream, and they repositioned themselves as content strategists, of which they could do video, they could take care of the video, but suddenly they went from 40 grand pieces of work to winning £250,000 programs of work over a long period. And I asked the owner of that business, well, that's awesome. How did you do it? He said, look, it's really simple. We just started talking about it. We ran events on it. We wrote pieces of content about strategy. We repositioned things on our website just to highlight our strategic work and reduce the emphasis on that we just do video production. So they moved upstream and picked up the right type of work from the right type of clients that gave them that long-term recurring revenue. Language is really important here. So often you hear the word retainer being used. I'm not a huge fan of that. No one likes being retained, right? I'm a much bigger fan of a program of work, and also focusing on the benefits to the clients, of which there are many, of having a program of work. So better planning. If we know that we're going to be working with you for a 12-month period, we can do much better planning, go much deeper, and that will get you better results. We can take a far more strategic approach to whatever it is that we're trying to achieve, rather than just focusing on this little narrow piece of work here. We can take a step back and look at what you're trying to achieve and make a bigger impact. Also, by committing to a program of work over the next 12 months or beyond, or a regular quarterly retainer, sorry, I've used the word retainer, regular quarterly program of work, you get the prioritized resource. We can better plan the resource. You get dedicated account managers, dedicated people doing the work. And you could also, and this is, the last tool in your armor, really. I'm not a fan of reducing rates, but if you need to, then encouraging people. If people ask you for a discount, one of the ways that you could, if you really have to, agree to that, is by saying, well, look, fine, we can give you a discount. Procurement are going to ask for it these days. But how about we work together on this program of work over the next 12, 18, 24 months? That gives you more commitment, prioritized resource. We can take a more strategic approach. And as a result, we can give you those more favorable rates. So all of those things will help. Now, we're on to the final pillar, and we're going to be taking questions shortly. So this next bit is often where I see businesses fall down, and I'll explain why. The final pillar of commercial success is planning and reporting. This is really important. I'm going to show you the framework which we work with clients at WOW is this. So we talk to clients about having an annual planning process, a quarterly strategic review, and then monthly reporting. That is the framework on which we can build our success. And we're going to look at each element in more detail. So the annual planning process, what this does is it forces you to make the big decisions that will help you achieve your objectives. And this, certainly if you're a business of scale, this isn't something that happens overnight. Typically, it's a process that involves not just the board, but all the teams within your business, and thinking about what it is you're trying to achieve. What are your longer term strategic goals? And then liaising with the teams and thinking about how they can contribute. And this can take, typically three months to do this properly and get everything bedded in. And in that process, what you're doing is the detailed thinking and planning that increases your chances of success. And it's the detail here that matters. You saw the level of detail I went into in terms of planning your new business pipeline. Have a think about the level of detail that you need to go into in every single aspect of your business, every single aspect of your business. It's hard work, and I know it feels like homework sometimes, but this is the difference between thriving and barely surviving, or maybe even not surviving. Genuinely, it's the detailed thinking and planning that unearths those big decisions, those opportunities to change your business for the better. Now, if you're a WOW client, we're going to take you through that process. We're going to show you how to build a profit forecast at an event on Wednesday, the 8th of November. It's an hour-long workshop. I'll be joined by Katie and Al from WOW, two accountants at the WOW company, and we will show you how to build your profit forecast, give you a framework, give you some tools for you to take away and go and do that. Now, if you're not a WOW client, what you're looking to achieve is a forecast that you can upload to your account system. So WOW clients will show you how to do that. If you're not, that's what we're all trying to achieve, a forecast that you can upload to your account system that shows you each month whether you're winning or losing. And those of you who use Xero and actually have a forecast that you've uploaded, you'll probably love the fact that you can hit a button and things go green and things go red, and tells you where you're ahead and where you're behind. So that's what we're all trying to achieve when it comes to the initial planning. Now, once you've done the planning, that's just the start. We haven't even scratched the surface. We then need to start running our race, and we need to make sure at various points that we're we're running in the right direction. And that's where the quarterly strategic reviews come in. So what these are about data, giving you the information that tells you how you are doing. From that data, you are able to unearth insights, really valuable insights that will inform the direction that you want to go in next, decisions that you need to make. And what these quarterly reviews is, they provide wonderful opportunities for accountability. And accountability is critical when it comes to that framework for planning and reporting. And by the way, it's not just a quarterly thing. I want you to think about your cadence of accountability across the whole business. What happens in your teams on a daily, a weekly, a monthly, and a quarterly basis that leads to your success? And by the way, not just accountability for your teams, to you or to the leaders within the business, but your own accountability. Do you have someone externally that you can go to that's holding you accountable? That's really important. As is this, we need to know whether we're winning and losing, and specifically where we're winning and losing. The example I shared earlier is really, really important. It's the details that really matter here. I heard a really interesting story. It was about a client who went into one of these reviews with our accountant. And at the start of it, as we do with all conversations with clients, he said, like, how things are going? How are things going? Client said, brilliant. We're doing really, really well. And the accountant scratching their head thinking, oh, the accounts don't say you're doing well. So we drilled down a little further. And what we discovered was they were winning loads of new business. That bit wasn't the issue. That's why they were feeling good about stuff. What they hadn't realized until we provided them with the data and therefore those insights was that their team and their consultancy weren't billing those days, weren't actually getting through the work fast enough. And so there were 500 booked days. So they had won the work that hadn't yet been put in the diary, that hadn't yet been delivered. And so there was this mismatch between the feeling and the reality. And so that's why those data insights are important. That's why it's really important that you understand the nuances of where you're winning and losing, and that everyone is clear about how they can contribute. So that was an easy one to fix, going back, looking at how the consultants were incentivized to go and clearly better contribute to the overall objective, which is cracking on, doing the work, getting the billing done. And by the way, there will be examples of that we'll have experienced in all of our businesses to varying degrees, helping the team understand that doing this action here results in a benefit to the business, whatever that action is, and really making sure that everyone is clear how they can contribute to the success of the business. Now, monthly reporting, super important. I'm going to get you thinking about a few things here. Are you measuring the right metrics? Do you know clearly that you're measuring the right metrics? In that example I shared earlier, unfortunately, the client was looking at the wrong metrics, or looking at some of the right ones, but not all of them. Do you have visibility over the things that matter in your business? Where are your blind spots? Do you know where they are, or do you not? You sat there feeling a little bit uncomfortable now. 3 things to think about when it comes to your monthly reporting: speed, accuracy, quality. So first of all, speed. Do you have management accounts within 1 month of your month end that you can hit a button and there they are? For the information that you need daily and weekly, can you click a button and is it there? Or is it a bit like wading through treacle? So have a think about the speed with which you're getting your information. Accuracy. When you look at those numbers, do you think, yeah, they're spot on? You trust them? Or do you have this sort of nagging feeling, hang on a minute, that doesn't feel right? I can't put my finger on it, that just doesn't feel right. And you have to go digging and suddenly you find it doesn't really stack up. Are the numbers accurate? And then also, have you got the quality of information? And by quality, I mean the level of detail. I talked about gross profit earlier and how it's important to measure that by more than just across the whole business, measure it by client, by project, by service offering, and potentially even by individual. Do you have that quality of data? And then have you got the right financial infrastructure for your size right now and the size that you want to grow into that's just giving you this information? Because when we were small, this was easy, right? We knew our numbers. I could tell you the numbers for the first couple of years at WOW off the top of my head. But as you get bigger and as you start building teams, things just get more complicated. Complexity creeps up on you. And if you don't get this right, then this can be the thing that kills you. I've seen so many businesses burn bright and then get to a particular point as the projects get bigger and as their wage bill gets bigger, and suddenly there's a lot more at stake. And the question is, have you got the right financial infrastructure to deliver this up the information? Have you got the right financial expertise in-house to interpret the data, to give you those insights? You know, do you sit there looking at the data and think, yeah, I know what this means, or do you need help interpreting it? Those are the questions you need to ask yourself. That is what we do for our clients. If you need help with either the annual planning process, those quarterly reviews, or the monthly reporting, your own financial infrastructure, or interpreting that data, we are here to help. This is what we do. We love helping people build beautiful businesses, and the foundations of that are these pillars of commercial success. And we would love to help you on that journey. Please get in touch.